So, you've got some money saved up, right? You're ready to make it work for you, but where do you even start? It can feel pretty overwhelming. Well, it turns out every single investment, from a simple savings account to a complex stock, really boils down to just one simple choice. And if you can understand that choice, you've got the key to getting started. And this is it. Right here, this is the core choice. The fundamental question every single investor has to answer. Are you going to be a lender or are you going to be an owner? As a lender, you're giving your money to someone else, and they promise to pay you back, plus a little extra, interest. As an owner, you're buying a piece of something real, like a company, and your fortune grows as that asset grows. It sounds simple, but believe it or not, every investment you can possibly think of fits neatly into one of these two categories. Okay, so let's walk down that first path, shall we? The lender. What does it actually mean to invest this way? Well, think of these as monetary investments. You're basically handing your cash over to an institution, like a bank, with a very clear and simple deal. You'll get this back later, plus a little extra for your trouble. Simple as that. The most common way you're already a lender is probably through your bank. You're definitely familiar with these. You've got your basic savings account. You can get your money anytime, but the interest is minimal. Then there are term deposits, which offer a better rate, but you have to agree to lock your money up for a while. And then savings certificates take it a step further, locking in both the time and the interest rate. It's a classic trade-off, really. The less access you have to your money, the more the bank is willing to pay you for it. Now, here's the kicker. When you lend your money to a bank, you get this huge layer of security. This number, 100,000 euros, is the amount that's legally guaranteed per person per bank within the EU. The source really highlights this because it means there's almost zero risk of you losing your initial investment. That is a powerful safety net. Okay, but what if you want to lend to someone other than a bank? It turns out banks aren't the only ones looking to borrow. Big corporations and even entire governments need to borrow money too. And when you lend to them, you're not just opening a savings account. You're buying something called a bond. Just think of a bond as a formal IOU. You give a company or a government your money, and they give you a piece of paper that promises to pay you back on a certain date with regular interest payments along the way. But, and this is a big but, that 100,000 euro guarantee we just talked about, poof, it's gone. With a bond, there's a real risk, however small, that the company could go bust or the government could default and not be able to pay you back. So how on earth do you manage that risk? Well, luckily, borrowers get a report card. Rating agencies literally grade their financial health from a perfect AAA all the way down to a C. This basically splits the bond universe into two camps. You've got investment-grade bonds from really stable, reliable borrowers. They're safe, but the interest you get is lower. Then you have speculative-grade bonds. These are your riskier borrowers, and to convince you to take that risk, they have to offer a much, much higher potential return. All right, so that's the whole lender side of things. Now let's flip the coin. What if instead of lending your money out, you want to own a piece of the action? This is path 2, the owner. We're now in the world of tangible assets, actual stuff you can own a piece of. And look, the number one way to become an owner is by buying a stock or a share. This isn't a loan. It's a certificate that proves you own a tiny slice of a business. If a company has 1 million shares out there and you buy just one, you literally own 1/1,000,000th of that entire company. Its factories, its brand, its future profits. Your fortune rises and falls right along with the company. And ownership isn't just about stocks. You could own physical property, like real estate. You can buy whole baskets of stocks through things like funds and ETFs, which we'll get to in just a sec. Or you could even own collectibles, fine art, classic cars, fancy watches. But let's pause on those collectibles for a second, because the source gives a really, really important warning here. And this quote just says it all. The price you paid for that painting or watch, it means absolutely nothing to the next person. These are often collector's items, and their value is incredibly personal and subjective. Trying to find someone who loves it as much as you do and is willing to pay for it can be a huge challenge. So maybe you're thinking, okay, I like this owner idea, but picking individual companies, that sounds like a ton of work. Well, you're not wrong. And that's exactly where an investment fund comes in. It's basically a giant pool of money collected from thousands of people just like you.
A professional manager then takes that giant pool and buys a whole bunch of different assets, spreading your risk out automatically. It's a way to be an owner without having to do all the homework yourself. Now, a super popular flavor of these funds is an ETF, which stands for Exchange Traded Fund. Here's the key difference. Instead of a human manager actively picking stocks, an ETF is automated. It's built to just passively follow a market index, like the German DAX or the American S&P 500. And because there's no expensive fund manager to pay, the fees are usually way, way lower. Plus, you can buy and sell them all day long, just like a single stock.
Okay, we've got path 1, the lender for safety, path 2, the owner for growth. So, which one is for you? Well, this is where the source material gets brilliant because it makes this fantastic distinction between playing a short-term stock market game, like a project for school, and investing your actual real-life.
Just look at the goals here. They're completely different. In a short game, you have to swing for the fences. The only goal is to make the most profit as fast as you can. But with your actual savings, whoa, that's a different story. Preserving your capital, making sure you don't lose it, is just as important, if not more important, than growing it over the long haul. And because the goals are so different, the tools you use have to be different too. To win that short-term game, you'd go all in on the owner path, right? You'd pick high-growth stocks hoping one takes off. But for your real-life long-term wealth, the source is crystal clear. You need a mix of both. You need the growth that comes from being an owner, but you absolutely have to balance it with the safety and stability that comes from being a lender.
Okay, let's wrap this up and put it all together. We've walked down the 2 core paths of investing, and we've seen how your goals totally change which path you should be on. So what are the key things to remember as you think about your own financial first step?
At the end of the day, here's the bottom line. Every investment you make starts with that simple choice: lender or owner. One path gives you safety and a predictable paycheck. The other offers the potential for real growth, but it comes with more risk. The true insight here is that great investing isn't about picking one path and sticking to it forever. It's about understanding what your goal is right now and choosing the right tool from the right path for that specific job.
And that really leaves us with the final question, the one for you to think about. Now that you can see the entire world of investing, not as thousands of confusing options, but as just 2 clear paths, which one does your own financial situation right here, right now, call for first? Are you in a place to start as an owner? Or does it make more sense to begin your journey as a lender?